All right, well, let's kickstart the show then and introduce Mrin Agarwal of FinSafe Advisories. Mrin, thank you so much for taking our time and joining us today on ET Now and on The Money Show. So Mrin, I'm sure you yourself have also seen quite a few of those interesting NFOs that are set to be launched. Just to give you a few examples, the Global Innovation Fund by Tata, then there's a New Age Digital Fund, there's a Global Blockchain Fund of Fund that's being launched by Invesco. Very interesting names. We have a couple of more, for example, from the HDFC stable too. What's your take of these, these differentiated offerings that are coming about, especially because, the world is no longer the same as it was, 5-6 years ago. So much has changed. What do you think of, the creative ways with which mutual fund houses are coming out with money-making opportunities and wealth creation opportunities?
Good evening, Mubina. Always nice to be here on The Money Show. Well, it is certainly very interesting times for investors. And I think it's really good to see that investors have more and more financial choices available to them. So if you look at, most of the funds that you mentioned are actually international funds. And earlier on, this space started with actively managed funds. And then, of course, there were some ETFs on NASDAQ, S&P and FANG maybe. And now it's getting more interesting and getting onto things that things like blockchain, where there's a lot of interest across the world. So I certainly think that it's very, very interesting times. But, with choices also comes a lot of confusion. And this is where I think it's very important for any investor to actually figure out what place does this fund have in my portfolio? Can I actually tag it to any of the financial goals that I have? And what is the sort of risk that's present in this fund? And can I take that risk, or, can that risk be taken for the financial goal that I would like to tag it to? So certainly you will need to try and understand very deeply as to where the fund is investing and how does it impact your portfolio.
Okay, I'm going to delve a bit more into some of these funds, but let's talk in general about the entire NFO environment. I think this year itself, we've seen mutual fund houses launch so many NFOs. I think they're sort of making up for the opportunity lost last year when COVID hit. What should investors look at when investing in a mutual fund at the NFO stage? It's akin to, a stock doing an IPO, a company doing an IPO of sorts, in many ways. So do what should an investor look at when they look at an NFO?
Well, the first thing is to understand where is the fund investing? How is it investing? So is it active? Is it passively managed fund? What is the fund track record is also important. And, as I said, how is this fund going to fit in the investor's portfolio? And of course, you need to keep an eye on the costs as well.
So let's talk about the cost bit. Expensive. Look, I can imagine that, an already existing mutual fund with its nice big AUM would have more ability to absorb cost, to be able to distribute it well among its unit holders. But an NFO, in the beginning at least, in subscription stage, would have fewer unit holders, etc. So do you think that there's more burden of expenses for NFOs rather than, investing in well-established mutual funds? And on an average, what's the difference like?
So if you look at the regular mutual funds, there is a grid that has been given out by SEBI, which typically works like this, that for AUM between 0 to 500 crores, it's 2.25%. And then 500 to 750 is about 2%. And then as you grow bigger, so let's say 5,000 to 1,000 crores, 5,000 to 10,000 crores, it's about 1.5%, right? And then of course, above 10,000 crores, it goes down further. So certainly larger funds are going to have lower expense ratio. And when you have NFOs that are coming out, certainly, if they're going to be, let's say, up to 500 crores, the expense ratio is going to be 2.25%. Now, when we look at international funds, if you're using the FOF route, so there are two expense ratios here. One is the underlying expense ratio, and one is the FOF, which is being managed in India, the FOF's expense ratio. So again, the SEBI rule is that FOF can have a maximum of 1% as its expense ratio, but that is the FOF's expense ratio. To that, there will also be the underlying expense ratio. So both of them would really add up. So that's how the expense ratios work on NFOs.
The other point in an NFO versus a mutual fund, when I have to pick a mutual fund, I know how that fund has done. I have past performance, so that gives me some sense on the manager's capability to perform in different cycles, in different market cycles. In NFO, obviously I don't have any information like that, though the probability is high that it will be a known manager who will be taking forward the NFO. So in such a case, if I am to gauge on what the prospects could be, on the managerial abilities as well, would it make sense to look at funds that the manager is already managing and how their performance has done? Or do you think that this is a drawback, that there's no previous performance history and hence you should avoid NFO for that reason?
Well, yes, I would say that it's always better to go with funds where you have data available, and I would only do an NFO if it was unique and it's not there already present in the portfolio, or I would only do it if there was something really unique about the fund. And again, a lot of the NFOs that I'm seeing are extremely concentrated in nature as well. So, NFO that's unique, which is not achievable by the current set of funds, and one that is not concentrated, which means that it's well diversified, then yes, certainly it's a good idea to go for an NFO. But when I look back at all the NFOs that have come in the last 1 year, for example, I think there would have been hardly one or two that I would have said, okay, worth looking at, but most of them have been, as I said, very concentrated or very thematic in nature.
Yeah, that's actually the case, and I think the ones that are launching, the new ones as well, the NFOs seem to be a little bit more concentrated, a little bit more thematic, though we have a couple of mid-cap and multi-cap names also launching. So Mrin, taking everything into consideration, let's say I ask you that, look, here's an already existing mid-cap, large-cap, small-cap fund, and here there's a mutual fund house that's launching an NFO in that large-cap, mid-cap, small-cap category. I'm taking the very basic mutual fund categories that already exist. So in such a case, Mrin, would you pick the already existing mutual fund, or would you want to go for the NFO, if, of course, there is existing in that category?
Certainly the existing funds that are there, I would prefer those.
Okay, all right. So let's talk about some of those differentiated NFOs, and I actually want your view on some of them. So the Tata New Age Digital Fund, Mrin, they've I think already put forward the papers with SEBI etc. for review, and now it's available for potential investors as well to look at. Your perusal, what's your view on this fund? Anything with the word digital off late in the name always attracts a lot of investor attention, given the fact that it is the buzzword today.
Yeah, actually, for some reason, all of these NFOs are reminding me of the tech bubble 20 years back, because you had so many of these ITES funds coming out at that point in time, and that's been replaced with New Age Digital, basically. So again, as I said, a lot of these NFOs are basically very thematic in nature, extremely concentrated, and I would say get into it only if you want to take that sort of concentrated risk in your portfolio. Get into it because you feel that you want to have a higher exposure to this sector. Maybe it could be a tactical allocation, but you need to be very clear about it that these are absolute high risk, very volatile. And these are current themes which may or may not play out in the future.
Okay, then the next one that I'm interested in knowing about is Invesco Elwood Global Blockchain Fund of Fund. If along with digital, there's another one that catches our attention, not necessarily a grey matter because it's such a complicated topic, it's blockchain. It's touted to be the next big thing. The underlying thesis would be used for a variety of futuristic functions that we will perform. What do you think of the Invesco Elwood Global Blockchain?
So again, when I went through the prospectus, what it says is that it will be investing in listed companies in the blockchain or the cryptocurrency ecosystem. When one looks at the fund right now, if you see, a lot of it is into companies dealing in cryptocurrencies and Bitcoin. And I think looking at the performance also, it's really been driven by the crypto and the Bitcoin prices. So certainly a lot of money has flown into this fund because I think the fund is quite big. It's $1 billion in size. But I do believe that, again, it's a lot of speculative money that's getting into this fund. And the fund is also very skewed towards crypto and Bitcoin companies. But, blockchain is used in many other ways as well. So, for example, one of the biggest uses of blockchain is in banking, right? And many other companies which are finding application for blockchain. I think it's an interesting bet. What I would say is that don't just go by the past performance. The past performance is looking really good because, as I said, it's been driven by Bitcoin prices and whatever news you're hearing about certain companies using Bitcoins and stuff like that. But I would be very interested personally in investing in a fund which is actually focusing more on blockchain application, right, rather than Bitcoin. So in the present form, I would really not recommend it because it's, again, highly concentrated in a very, very speculative and volatile play. No doubt it's going to attract a lot of investor interest. But I would say that if you have a fund which is going to focus on blockchain application, companies into blockchain application, I think, that would be really a good fund to get into. But in the present form, this fund is very high on companies that run, let's say, a crypto exchange, for example, right? Or companies which are into Bitcoin mining, for example. So in the present form, I am not very enthusiastic to invest in the fund because of the skewness towards crypto and Bitcoin assets.
So finally, Mrin, just to summarize our conversation, and just for our viewers as well to get a holistic view, a holistic take on your view on NFOs, what are the risks involved in investing at NFO stage in any mutual fund?
I think the first risk is the fact that people believe that they're buying it cheap. Like everybody thinks that, okay, I'm getting it at 10 rupees. It's very cheap. Honestly, it doesn't matter. What really matters is the growth from this particular level. So that's point number one. Most NFOs tend to come out at market peaks, and a lot of these thematic NFOs also come out at market peaks. So for people who are investing, they need to be aware that they're probably getting in at high valuations, which means that they need to have a long-term time frame when they invest. And if they're getting into themes, of course, the risk always exists that the theme may not play out. So if you are getting into an NFO, please evaluate it to see if this is something that you can actually hold for the long term. And certainly you need to have your returns expectations in check if you're entering at current levels.
Okay, well, you know what, let's take on board some questions and queries then. Remember, folks, you can send in your questions to us on the Money Show at etnow.tv. We've got quite a few coming in for you, Mrin, so we're going to attempt to answer some of them. Our first question is from Ajaz T. He says, I've invested in the following funds and would like to invest on my wife's behalf. I am predominantly invested in Indian equities and I don't mind investing in international market for diversification. He wants to know your view on that. He's also confused between the Nasdaq 100 and the S&P 500 top 50. And also he wants to know on the US market and the Greater China funds, is it okay to invest 60% in US, 40% in China, either through Axis or Edelweiss, which are the, some of the houses offering these two indices. So the existing Indian equity funds are Mirae Asset Emerging, Axis Growth Opportunity, Parag Parikh Flexi, Edelweiss recently listed IPOs, Canara Robeco Focused Fund, and Edelweiss Balanced Advantage Fund. So this is his existing portfolio. He wants to add a few international funds too. Mrin, what's your take?
All right. So when I look at the existing portfolio itself, he's got Axis Growth and Parag Parikh FlexiCap, which already have international exposure. I do not recommend the Edelweiss recently listed IPO fund. So of course he's invested, he can hold on for some time, but this is not something that I would want to hold for the long term. Now, with respect to the international funds that he wants to invest into, so first thing I want to say is, it's not mandatory to do international funds. I mean, if you really feel you need the diversification, you should do it. The second thing that I want to say is that when I look at NASDAQ 100, or if you look at the S&P 500 top 50 fund, these are again highly concentrated and focused on the IT sector. So, of course, NASDAQ 100 is all about the tech sector. But even if you look at the S&P 500 top 50, it is primarily, if I'm not mistaken, I think it was 37% of the holdings would be in tech stocks, right? So it's very, very skewed towards one particular sector. And, anything that's very highly concentrated is going to be high risk. Now, again, when you're looking at investing from the long term, the other thing that I also saw was that the S&P 500 top 50 fund versus just buying the S&P 500, there's not that much difference in the overall performance. When you're looking at investing into an international fund for the long term, look at something that's diversified and that can give you exposure across the world. Yes, US markets are doing really well, and to that extent, European markets are not doing that well. But I would always look at something that is more diversified, not only in terms of geographical diversification, but also in terms of sector diversification, which I find missing in NASDAQ 100 and S&P. Of course, S&P top 50 has some sector diversification. So again, with respect to China, I'm not sure whether you should get into China at this point in time, given all the restrictions that we are seeing coming in on technology stocks. Now, even on entertainment stocks, there are some restrictions, I think, that have come in. So, given all the restrictions that one is seeing coming in China, I'm not sure whether, it's a great idea to invest into China at all in the first place. And actually, my recommendation would be an NFO. Typically, I'm one of the last people to recommend an NFO, but I wouldn't mind looking at the new HDFC fund because, this is an MSCI World Index fund, which is going to give you exposure to US and Europe as well as Japan. And when you look at the portfolio of listed companies here, it's a good portfolio as well. So actually, my bet would be to, if you do want to do an international fund, which is well diversified, I would actually suggest the new HDFC NFO.
Well, that's all the time we have then to take on board questions and queries. So, Mrind, we leave it at that. Thank you so much for taking our time and joining us today on The Money Show. Always a pleasure.